event is Issues with Developers, and today our panelists will discuss the keys to addressing issues with developers. NSP grantees and their partners will see examples of common issues grantees have faced and learn about solutions for NSP grantees to overcome these problems. Presenters will give guidance on what to look for before choosing a developer and what things to monitor during the grantee-developer relationship to ensure high developer performance. In addition, the presentation will cover the basics of what to do to ensure success with developer partners, how to handle poor performers, and what needs to happen to make sure developer projects are carried out and completed. This webinar is interactive, and participants will have an opportunity for questions and answers after the completion of the presentation. So with that, let's go to our panelists, and we have 3 people today from Enterprise Community Partners with a great deal of experience in working with the kinds of developers who tend to be involved in NSP programs. Ben Nichols is Senior Program Director with Enterprise and located in my hometown of Cleveland, Ohio. Mai Trin is a Program Officer and works for Enterprise out of their Los Angeles office. And Matthew Doe is a Program Officer and has been a main point person for NSP at Enterprise since the program's inception, and he's based in Washington, D.C. Greetings to each of you. And from Hyde Central, we're also graced with John Laswick and David Noguera today. And so hello to everyone. And we'll start with Ben Nichols and Mai Trin.
Great. Thanks, Kent. So, here's the agenda for what we're going to do today. We're really going to talk about the different, issues with developers, and we want to kind of run through, taking a look at who developers are, what the risks that their organizations or their individuals, they personally and professionally face when they're undertaking a project, and what some of how those risks can impact, the project, especially, in delays, which is, very key with time-sensitive money like NSP. So we're going to look at the developers, and then, give you guys an opportunity to hear about, really, what should be some of the keys in selecting developers, and then really monitoring what's going on, and then at the end, talk about some best practices from the developer side as well as from the funder side or grantee side for you guys. And so then we'll wrap it up really with some questions and answers, and hopefully we'll have some recommendations to this that you guys can take back and think through, wow, that's really what's going on from the developer side. Here's what we can do as NSP grantees to help them get their projects built, and we can get our NSP money out the door. So with that, we'll start off with the NSP definition of developers. Matt?
Sure. Thanks, Ben. Good afternoon, everybody. Just wanted to set the context for the day by looking at the definition of developers for NSP. So really, who are we talking about? What type of entity is this? And really, some of the things we talk about here will relate into agreements and then also working with these types of organizations and entities. So what we're talking about is either a for-profit or private non-profit individual who's acquiring homes and rehabilitating homes, and also doing new construction as part of redevelopment. So that's one of the keys there is it's a private non-profit. The next bullet down, public non-profits such as housing and redevelopment authorities cannot be developers. So these folks are always going to be sub-recipients for the purposes of NSP. And finally, there needs to be some risk involved. When for the program to consider an entity a developer, there needs to be some risk. And this point here is that there needs to be ownership or control of the property by the developer. So really, for the program, there's not a large number of qualifications that make an entity a developer, and there's really no mention of the developer administering part of the program for the grantee or being subject to any of the federal administrative requirements, and that's a key because the developer really isn't considered part of the grant administration and part of the grant program. So we won't today be really talking about NSP rules and regulations a whole lot with developers because they're really outside of that that structure. And it's helpful at some times to think about them as end beneficiaries to the program rather than a part of the program itself. So we're going to talk about tools and ideas to mitigate risk and manage relationships and some of the issues that come up. And with that, I'll turn it back over to mine, Ben.
Okay. Thanks, Matt. All right, so first up is really selecting the developers, and we're going to break these into three categories. First would be financial benchmarks, and so that is to get to the financial wherewithal of an organization. A little bit of a checklist on the developers, and then finally some NSP selection criteria. So first up on the financial benchmarks. So here are a few financial ratios. So if you are receiving an audit or financial statements for a developer, here are the benchmarks that we would use for what I would consider a high-performing developer of doing a low-income housing tax credit project. So that would be, a project of at least 40 or 50 units, probably, many millions of dollars of equity. So that's not going to meet everybody's needs for what the developer is and different size of projects, but so if it's a bigger developer, we get comfortable by them having a current ratio, which is current assets to current liabilities, of over 1.5. That means for every current asset they have, or for every current liability that they own, so money they owe in the next year, they have $1.50 for in assets that they can pay that off with. We look at 4 months operations of cash. That means that they have 4 months worth of expenses in cash on hand. So that's a lot of cash that makes the organization really go. A cash balance of at least $1 million. Leverage, which is total liabilities to net assets, or to equity if it's a for-profit group, of 3 to 1, which if you're thinking of loan to value would really be about 75%, or 3/4 would be debt and 1/4 would be equity. And then a net assets or equity base of about $5 million. Yeah, so this is a significant size organization, a good size CDC or Toto who, or even a for-profit that has the financial wherewithal to do a project that's going to take, $8 to $12 million to, they will be able to have financing, they'll be able to leverage their cash balance plus their equity that they have in the organization to do these. So why do we need these ratios? We use these types of ratios really for a couple things. One, to look at the financial picture of the balance sheet and the audit of the organization and understand what those numbers are telling us. And secondly, really to get comfortable with the risk. So, as I mentioned, we feel comfortable with these numbers for a group that's going to do a large project. But, that may not be the case always. So, next slide, please. So you guys may not have that luxury to select a development partner that's going to be able to do a 50-unit, or you may only need somebody that can do 1 or 2 units. So how do we balance that? It may not be $1 million in cash that's needed for a group to do 2 single-family homes with NSP funds. It may be that they need a lot less. Maybe they only need to have $100,000 on hand, or even have a bank line of credit where they can, pay for their materials and pay their subcontractors or GC or whoever it needs to be before they draw money from you guys. So, it's about really looking across that continuum of who's developing. If somebody is going to apply for a project that's 10 units, their financial needs or your financial comfort level with that organization is going to be a lot less than somebody who's doing adaptive reuse of an old factory that's going to cost, $15 million. So you have to really kind of balance that across the continuum of where that ratio would be. So who only has a credit card to the local hardware store or the Home Depot. So that person, may feel comfortable just having a $10,000 to $20,000 credit line at the hardware store. But, you're not going to give that person 5 units or 10 units to do, because it's really going to take a long time for that person to do each unit, to draw down $20,000 in materials, then bill the city or state or the county, whoever their grantee may be, and then pay back the Home Depot or the hardware store, and then draw another $20,000. It's going to take a long time, and that project's not going to get finished within the required time period. besides just looking at the financial wherewithal, we want to do a couple, look at a checklist of some other issues. One, really strong financial reporting. We want to make sure that especially if it's an organization, that they can get the financial information to you that you really need. And plus, that you can tell from that what their financial health is. You want to know that they have excellent relationships in the community. So one, it would be with bankers and investors, folks that can, feel comfortable investing in them as an organization or as a developer, so that they can use that money to, leverage the NSP dollars, or even to really be the bridge and the front money for the NSP dollars until it comes in later on a cost reimbursed basis. Secondly, you want to make sure that they have great relationships with other parts of the city or the county, so that they're not having issues getting planning permits, or if there's a zoning variance, that everything's going smoothly. But they may even, go over towards political folks too, so that if the developer has had a dispute with a council person and they want to build something in that council person's ward, what are the chances that that's going to get, they get stuck in some city council or some other, if there's a variance needed there, will the council person not move forward on that project? And so that could really slow things down. And then finally, this is on the relationships, GCs and subcontractors. What we see, of course, is that developers have long-standing relationships with general contractors, and the generals, of course, with their subs. And the big question here is, what is their capacity? So if we've had NSP has been a good opportunity for folks to really grow. So if we had a contractor, or a developer who's worked for the contractor who's always turned out, 5 or 10 units consistently every month or every 3 months, and just like clockwork, and done really well. And all of a sudden we push that developer, who then in turn pushes the GC to do 15 units a month. Are they able to get all those units done? They start having to strain that system for the general contractor, the sub, and even the developer, which means that there's going to be either another general contractor is going to have to come in, have a new relationships with that developer, and that's going to, add some time to the project. As well, if the general is going to do more work, then they may need more subs, and that's a similar thing. They're going to have subs that they're not as familiar with, and that they're going to strain some of their system, and it could slow down. So it's one of those things. If you're seeing from your office, this is a great opportunity for us to grow the local CEC or CHOTA, and it is. You want to make sure that we're not putting too much stress by giving somebody more than they can handle. Similarly with the organizational capacity, is that CHOTA, is that developer who has a good staff of a couple of people who can turn out a few houses or work on a multifamily building, to give them that second, 8-suite building, or 2 or 3 more single-family homes? What type of stress is that going to put on their organization to deliver on all the units? Because that, as we look at the timeline again, it's just going to, impact it. And then finally, on forecasting and scenario planning, we want to make sure that the developers have another plan B. We want to make sure that when they come in and talk to us, it's not just, well, as soon as these 2 things happen, everything's going to be fine. We need to make sure that they actually have a plan B, instead of just saying when these things happen.
I'll pick up there and add on for NSP to that checklist of selection some ideas and considerations to think about when doing a selection of a developer. The selection or procurement of a developer is not required by HUD or by the NSP program, but many grantees, especially local governments, have selection criteria set up and will do that regardless of whether it's required or not. So what are the things you want to look at? Ben touched on some of these. You want to review the developer's experience and capacity to work with federal funds. There are many good developers out there, some of which don't have the best back office and really aren't strong on the reporting side. So that's something you want to consider. If the developer you're looking at doesn't have that experience, You want to know that up front and manage that risk, or know that it may be a risk. You want to know the developer's background and lines of business. Recently, with the changes in the downturn in the housing market, developers will naturally go to rehab if that's a major portion of an NSP program that is really responsible for a lot of development activity in your community. So again, these aren't requirements, but something to know up front, something to manage, or to know that you'll have to manage as you work with that developer through the program. And then finally, if you're doing more of an RFP and you're actually getting specific projects with proposals and with developers, you want to make sure you get all your development budgets, performance, all the information that you'll need to do your feasibility, to do your due diligence up front. Because really, you're not just selecting the developer, you're selecting the project at that point. Next slide, please. So, natural progression from just looking at selection, I want to talk about the developer agreement. And this is an important aspect, especially as I mentioned in the opening. The developer really it's not the same thing as a subrecipient. They're not managing the program. They're not subject to the same federal administrative requirements. So the agreement is going to be a big tool and really the only legal tool that you'll have available. So here are listed some of the key elements that you want to make sure you have. Scope of work, that's self-explanatory, but something that gets overlooked is who's responsible for what. So throughout the course of the development, is the grantee going to be responsible for certain items? Is the developer going to be responsible for certain items? Through the disposition of the property, something to be aware of. Putting milestones in the agreement. In connection with the next bullet, talk about deadlines, but milestones will allow you to track progress through the development time frame. So things like a certain number of acquisitions being completed by a certain date, a construction start date or number of starts by a certain time, 50% completion on the construction. So these types of things to have as milestones will create a more robust set of criteria than one end date. And we're kind of getting close to the NSP2 50% expenditure deadline. You can obviously imagine how difficult it would be to have a single set date, February 2012, as the only deadline in your agreement to expend a certain amount of funds. So milestones are certainly important for the agreement. Performance requirements, you're depending on a developer in most cases to really produce a certain number of units that you've really committed to in your NSP application or substantial amendment. So make sure it's very clear in your agreement how many units, by what time frame. And finally, a strong termination clause. And this isn't really legal advice, but sometimes a relationship just isn't going to work out. So as your agreement, define the process to end the agreement. And how long will it take? I've seen agreements that allow for a 30-day cure period and another 30-day notice period, and you may have another time period after that. It becomes a lengthy amount of time. If you need to make quick adjustments with the program, it's certainly an important consideration. You can go to the next slide.
Okay, great. Thanks, Matt. So let's switch gears a little bit. We talked about selecting developers, and we talked about the NSP regulatory agreement. So now we've got the agreement in place, and the developer is working on the project. How do you monitor the developer, monitor the project, and make sure that it's on track? What we found is that, Ben talked about the selection checklist for developers, and part of that comes from some study that we did about failing, housing organizations that were either failing or went to the brink of failing. But we also talked with really strong developers as well while we were in the process of doing that and coming up with recommendations for what good housing developers should do. One of the things we found was that strong developers tend to use construction and operations dashboards, and it's a way for them to organize, it's a way for them to determine which projects to focus their attention on when they're tracking a large number of projects. So I'll go over a construction dashboard criteria, which is a way to organize the dashboard. We'll go over a sample dashboard, and then we'll talk about monitoring under NSP. This is just a sample construction dashboard criteria, and what we've done is on the left-hand side listed some important criteria for the construction phase of a project, and that would include scope, whether or not the scope remains the same, it's shrinking, or it's increasing, whether there's significant changes that increase the amount of work that a developer needs to do. Schedule, whether or not the project is on schedule, ahead of schedule, or delayed by a significant amount. Sources and uses, whether or not the project is within budget or going over. And then tax credit adjusters or other funding gaps, whether or not this project is going to go over budget or is going to be delayed enough if it's going to experience tax credit adjustments, and whether or not there are funding gaps that are going to come up in the future. And then on the top, across the top, we have 3 buckets for each project that you'll want to put the projects in. The first one is on target, and as you can see, the scope remains unchanged, or there are only minor changes to it for a project that's on target. It's on schedule, or it's ahead of schedule, it's within the budget, there aren't any issues. Because there are no delays, there are unlikely to be tax adjusters, and then there aren't any funding gaps. When the project's on target, then it means it really doesn't need a whole lot of review. So what we put in the review section is that maybe this project only needs to be reviewed on a monthly basis, and depending on your capacity, maybe it only needs to be reviewed on a quarterly basis. This is going to depend on your comfort level. But next, we also have a monitor closely bucket. So those are the projects that maybe we're a little bit worried about, where there's some medium changes to the scope, or it might be 1 or 2 months behind schedule, where the cost might be projected to go beyond contingency by a certain amount, or the contingency is being drawn down, but the amount of construction that's done contingency by a certain percentage of the total development cost, or a certain percentage of the corporate liquid assets of the organization. And then maybe there's a little bit changes in equity, and it's projected to expect a little bit of tax credit adjustment. For those kinds of projects, we put it into the monitor closely bucket. It's something that you'll want to look at more frequently, and so it may need to be reviewed on a weekly basis or as unexpected events occur. And then finally, we have the workout bucket, where there are significant changes in scope, where it's significantly behind schedule. I mean, it could be one of those things. It could be both of those things that put a project into the workout bucket. And it's going beyond budget. There isn't contingency remaining, or you're expecting that it's going to require additional cost in order to finish the project. And then you may be expecting tax credit adjusters as well, and you're expecting that there's a huge funding gap. So for those projects, again, like the monitor closely bucket, is something that's going to need to be reviewed on a very frequent basis, and it might be a weekly basis, it might be more frequent, it might be as unexpected events occur. So these are just some sample criteria that you might want to use for a construction dashboard criteria for projects in order to track the ones that you really need to pay attention to, rather than having to review all of the ones that are on target as well. So here we have a sample dashboard, and the way we've organized it is to have the red, yellow, and green buckets, the green being the ones that are on target, yellow being the ones that need to be monitored closely, and then red being the ones that are in workout. And as you can see, the criteria we have on the left are really the ones that we had in the previous slide, which is, are these projects on schedule? Are they within the scope of work? Is there a funding gap from them? And then on top of that, we've also, because these are NSP-specific projects, we also want to make sure that NSP deadline isn't an issue and that it's compliant with all the needs of NSP. So if we look at a couple of these projects, Green Briar, for example, we see that it's on schedule, so it gets an A for schedule. The scope of work has some minor changes, so it's getting a B for scope of work. Funding gap, there isn't one, it's on target, so it's an A for that, and the same with NSP deadline and NSP compliance. To go down a little bit further in the dashboard, we can see that we can make comparisons on Green Briar for this month compared to last month and the 2 months prior. So in the current month, we see that Green Briar received 4 A's. So it's very clearly in the green bucket. And it got 1B, which is not an improvement from the previous month or 2 months ago where it had A's all around. So that might be something for management to pay attention to. But if we compare it to Bella Vista, for example, which is in our red bucket, we see that it's 3 months behind schedule, and that there's some changes to the scope of work. But there isn't a funding gap. But the biggest issue is probably that there's an NSP deadline issue on this project. So we're watching this very closely because it's in the red bucket. And so this is an example of a dashboard that one might use in order to track a large number of projects.
And just a couple of points on monitoring for NSP. Monitoring, as everybody I'm sure knows, is an expectation and a requirement of all the NSP grantees. And that's also true of the developers, although the nature of the relationship is a little bit different. So the first step of what we're proposing as a two-step process is really what we've talked about so far: selecting qualified partners, establishing the performance criteria, really using your agreement to establish those criteria for performance and the goals, to add milestones and deadlines directly into and embedded into the agreement. And the second step is really to monitor to those criteria. So verifying partners are meeting goals, also verifying federal requirements. So federal construction requirements such as data spacing, Section 3, you really want to make sure those are part of your monitoring plan. In addition to that, while the developers aren't subject to some O&B circular requirements and things like procurement, you want to know and you want to be able to monitor for how the funds are being spent. So looking at receipts, looking at expenditures, making sure the developer is accounting for those in a clear way, and then making sure that all the costs which make up the TDC, which is an important concept for NSP, can be verified. So all of those items are really pushed into this monitoring plan. And really, why is it necessary? One, because it's a requirement, but also because you're really wanting to manage your risk. And development is really a large part of development is managing risk. So your monitoring should really align with risk management, using things like a dashboard or a checklist, and really making sure your performance goals are a big part of that.
So next we'll talk a little bit about developer best practices. This is really to flesh out the checklist that Ben had talked about earlier and why we came up with that checklist. Like I mentioned, Ben and I did a study of 10 failed or failing organizations, and we ran a paper called Building Sustainable Organizations for Community Development and Affordable Housing Impact. And from doing that, we discovered that it was really important for organizations to strengthen financial reporting, monitor large cash receipts carefully, grow strategically, and cut revenue-draining projects. We have a number of other recommendations. You can read the paper, but these are some of the most important ones that we noticed. We're also going to talk about NSP best practices.
All right, so first up, the strengthening financial reporting and analysis piece of what Maya just mentioned. You know, we really saw two things from organizations that were failing or near failing that really for NSP grantees is that when you guys get financial statements from one of your developers that you're monitoring for projects that you have money into, and you can't read the financial statements and understand them, you know, you should ask that same question to developers. I mean, it's really accurate to say that if you're having questions, they may be having questions too. And we saw this a lot. You know, they weren't broken up by cost centers, so the owners and developers and nonprofits didn't know which programs were making money and which properties were making money, so it was an issue as well. They hadn't been allocating overhead to their financial statements to the different cost centers, so they weren't sure like what the proper price and should be charged, so that they could at least break even for the work that they were doing. Secondly, accounting staff turnover was a really big issue. These developers are complex organizations that have lots of subsidiaries, and like even in a tax credit deal, there's at least 2 subsidiaries that are formed for each property done. So I mean, there's a lot of different organizations, and figuring out how they're all interrelated is really hard to do, especially if you're a new accounting staff person. Secondly, there are a lot of compliance and regulations. So, if somebody new comes on board, for them to learn the NSP regs and other HUD regs and even other government programs from HHS, the Department of Energy, any of those, it really becomes a lot of an issue, and they need to need that time to at least get up to speed, understand what the regulations are, and then also to understand what the documentation that they need to submit, either to NSP grantees, to you guys, or to anybody else to do a draw or whatever. If they submit the wrong information, they're not going to get the money. And until they do get the documentation in properly, that's when they can finally get paid. And if they're an organization that's cash-strapped, by doing that, they're slowing themselves down and getting the project finished because they haven't gotten the right information. So if you hear a lot about, one of your partners has turned over the staff or the accounting staff of their organization, then maybe a signal that, is there something we can do to help them out? Maybe we can hold a little training, or we can meet with that person or the new accounting people there so that we can get them up to speed on what documents, because especially if the NSP deadline looms, having those types of meetings and reaching out may help them get the information in quicker and may help them draw down that money faster. And then internal controls, by having accounting staff turnover, it automatically opens up an opportunity for theft or fraud, and it just unfortunately happens from time to time. And so, we just talked about what that means for you guys. I think, if you look at statements and they're not well written and they're hard to really understand what's going on, I think that's a signal. And as well, accounting staff turnover, I think there's an opportunity for you guys to reach out to them to really make sure that they're drawing and understanding the regulations. Next, monitoring large cash receipts. Real estate is a business of large uneven payments, which is for sure, a lot of developers put their money in pre-development, or they're bridging funds like NSP, or at least through the construction period, and then they get developer fees usually on the back end, and so they're waiting for that big payment to come to them. And what happens is that these payments are really, if they get a large payment and they may not be using, they may delay their decision on a property or business that's not performing, because they can use that money that comes in their door to subsidize that property or business. And, by doing that, they continue to just kick the can down the road and not tackle that problem today. And so that can create a problem further into the future for an organization. And how does this affect you guys? Well, what happens really is, because of the large payments, if something gets stalled in the pipeline, then it could potentially stall the NSP project. If a LIHTC deal or tax credit deal is before the NSP project and that project hasn't closed, or there's a gap, it's really stalling and slowing down the NSP deal, because a developer's equity and the money that they hope to earn is in that first project and can't get to the second project. So is there a way to help them unstick that project? Maybe both of those are in your jurisdiction, right? So maybe the first deal has an issue, it can't get a permit, or it can't get a zoning variance, and if one of those things were to happen, then the project could move forward, and then it would release some of the developer's equity, and then he or she could put it into the NSP project. So, what's really slowing them down? Is it just this project, or is there other projects that are a problem? So, and if there's too many units, maybe there's just not enough financing. So if an organization is trying to take on 25 or 50 units when there are usually only 10 to 20 units, it could be really a problem for them to extend on a line of credit or cash that they're used to. So maybe there's just not enough money there for them.
Next is providing strategic a lot of services. The big question is whether or not they're doing it strategically, whether or not they're really positioned to be able to take on an NSP project. So what we suggest is that organizations need to build on existing core competencies. So when you're looking at your partners, the question is, do they currently have other capacities that position them well to take on NSP? Are they moving away from their mission as they're taking on NSP work? What we found with scaling organizations is that they tended not to have the infrastructure and tended not to have the relationships in ways that they're in territories or business lines that they were growing into. This was a particular problem for property management, where organizations may not have had the scale, the capital, the resources, or just didn't build in enough of a timeline for them to be able to do the business and get to a point where they were breaking even and making revenue for the organization before this particular business line hurt the organization a great deal. So the pitfalls of a new business line or territory are that there may not be the expertise or the infrastructure built, and there may be weak relationships in the territory. Do you want to add to that, Ben?
Yeah, so we are chasing NSP projects. So, one of the things that we saw, not particular to the NSP deal, but something to watch out for, is that we saw groups that were pushing to the brink, saying we really need to find a deal that's going to, put us back on track. So it could be a developer that may have moved outside of its normal jurisdiction or service area. It could have been a developer that went and did a multifamily deal when it was traditionally a single-family developer, or developer chose a large project and traditionally did small projects. And so we could see this as an opportunity where NSP, after a couple of years of probably lower developer fees that developers saw, an NSP program as an opportunity to really hit that home run and get themselves back on track. And, that's something to really watch. You can go back and look at the financial statements of a project that's, of a developer who's really slow in the project and say, maybe they did bite off more than they could chew, because look at their financial position when we started this deal, or since the deal was started. So is there a way that we can help them through this, or is this then a signal to us?
Next, revenue-draining projects. We have a photo of a black hole here because this is what some of our partners have called these. And they could be projects that are in the pre-development pipeline. They could be projects under construction or projects in operations. In any event, they are projects that are either have huge cost overruns or projects in operations that have a large negative cash flow that are taking up a lot of resources from the organization. And in addition to that, they're also taking up a lot of senior management's time, because the senior management's unable to take care of the day-to-day duties or can't spend time on an NSP project. And so it becomes a huge burden on an organization, as we've found, that when this happens, it could also cause an organization to fail. So I mentioned slow-flowing pipeline before, and this is the same issue here, where if all the resources are being devoted to the workout of one particular project or two projects, then it reduces capacity to do work elsewhere, both financially and in terms of staff resources. We can also be optimistic people. So we've saw organizations that said, if these 3 things happen or these 5 things happen, then everything will be okay, despite the fact that there is, this one project that's draining a lot of resources. It's really difficult for them to walk away because there are a great deal of sunk costs. It might be a project that they've spent $400,000 in pre-development funding on, and the way that they think they may recoup that is by making sure that the project comes to fruition. And unfortunately, for some organizations, this was not a good strategy, and it caused the organization to fail.
So just looking at some of the NSP considerations related to developer best practices, some of these really overlap with what Ben and I just talked about. The first one being experience of the project type, then talk about chasing NSP projects. When you think about the program between the eligible uses and activities, acquisition, rehab, redevelopment, demolition, new construction, land banking, there's a variety of activities that communities are undertaking with NSP, and there's a lot of expertise that goes into really managing those projects. And from a development side, does your developer really have that experience in the project type that you want to take on with your program? We talked a little bit about partnerships, and particularly here with these notes on the back end for disposition, banks, realtors, and counselors. You really hope that you're relying on your developer to do much more than just construct a home. You really hope that they have a reach out into the community and have those partnerships. And if they don't, that they're willing to use partners that you've established either through other programs or specifically for NSP. A strong marketing plan. I think marketing and selling homes is sometimes difficult. A lot of places are working in challenging neighborhoods. So really having that strong marketing plan, thinking about marketing well before the unit is completed. And really the final point is providing a point of contact, which is a pretty simple idea, but flexibility has certainly been important to this program. The pace of the program has been quick with expenditures, with obligations for NSP1. And really the evolution of the program. There's a lot that everybody's learned at one time. And having one single point of contact with your partners is a nice way to keep in touch, keep your finger on the pulse of what's going on there, but also to communicate updates as they happen with the program.
Hi, issues developed on a few of the different pieces around that we've talked about so far and maybe come up with some recommendations. Alright, so when we're really kind of in an issue with some of our properties and our projects, and the developers, so let's step back and ask ourselves a few questions as NSP grantees to make sure we know what's going on. So what is really causing the delay of this project? Is it another project or projects in that developer's pipeline? And I know that was one of the big issues that we just kind of hit on several times. That if they have other properties that are slowing them down, and such as black hole property, and I think it's really sucking up a lot of time and effort from that developer, and that's probably slowing us down. So is there anything that we can do as NSP grantees, and then if that deal is in our jurisdiction, there's something that we can do to help? Problems with financing. If ends up that there's a gap on this problem, or that our developer is tapped out, that if he or she is just not able to get any more money, then what should we do there? Should we feel comfortable increasing the amount of NSP going to a deal? Or should we, and this is a tough one, should we even advance funds as opposed to doing cost reimbursement? Is that a way to get money on the street? I wouldn't propose advancing funds to any developer that just, any Joe Schmo developer that came in the door that you don't have a relationship with, but maybe somebody who you've had a long relationship with. It would be worth it to get that project out of the ground by giving 10 or 20% up front so that they could move the project along. I would say that's really up in your judgment and a case by case, but that's one way from the financing side. Problems within the jurisdiction. Again, it could be anything from zoning and permit issues and all the way up to council support. And is there anything that your department can help with, or is it something just knowing that it's out there and that this is really going to, this project is not going to be able to get over this hurdle? And then, of course, NSP rules in general. Are some of the rules just steadfast to the point that, and written in stone, that we just can't move this project anymore? And, it does happen from time to time, and it could be either things written into the work plan that we've kind of we've focused too narrow for our jurisdiction, or maybe it's some of the overall compliance issues that have created some issues, and that's something we need to look at and figure out what the problem or what is. Is the project facing a previously unforeseen gap? I mean, real estate deals, it's one of the risks that we always deal with, especially rehabs, is that there is a bigger gap than we originally thought, and and what are we going to do? Are we going to, again, allow more NSP funding? Is it something that should have been foreseen by the developer? The developer just kind of really underestimated his or her numbers, or, what should we really do? Did the developer overpromise, which, kind of goes to the Hail Mary, developer really trying to find that deal to get back on track, and if they did, how do we instill the pressure as the grantee and being on the hook for getting the NSP deadline, to make sure that that developer can deliver. And, kind of going back to Mize, talk about the green, yellow, and red buckets, and maybe one of the remedies for this is that the developer's got 30 days to do something, and we just need to put the pressure on to get it done to move forward. Because if not, if we look for those questions and we can't get them, should we just end the relationship or modify it in some way and say, you're supposed to do 10 houses, you're going to deliver on 2, so you can do one more, and we're going to have to modify that contract. Recommendations for grantees. So, incentivize the long-term ownership of the units, or really what this means is we look at that really from like a rental perspective, but keep your self-imposed NSP part the rules as flexible as possible. I think, when we did work plans and we submitted to have NSP2 applications, and we said we're going to spend money in this way, and we want so much money to go to a single-family rehab program and so much here, it sounds good up front, but then when it gets into practice, the more and more rules and the box that we draw ourselves into, we get stuck in that box. And so the more that we can be flexible and work with the developers, I think is really good. As well, embrace an early warning system. If there really is an issue with either a developer over-promising or may have made a mistake on underestimating the cost, make sure that they have the opportunity to come and talk to you about it. Make sure that they feel that there's not going to be a penalty just for bringing up an issue, especially when there was simply a mistake. If there is a mistake and they do happen, and they need to feel comfortable that they can come to you and really, make this project work and get done. And if it can't get done or it can't work, then it can't work. But I think what happens is a lot of times developers feel that if they approach a city, a state, or even a bank as one of the funders, investors, they're going to say they're going to be put on a blacklist, or they're going to be, just run out of town and run out of business. And if that's the fear that's out there, they need to know that if they're transparent, that we as NSP grantees are there to help them and get this done. Because if it's not there, then there's this, that's going to continue just to delay a deal and just delay it and delay it and delay it.
We're going to switch gears a little bit and just look at some problems and some thoughts and considerations for solutions that have come up for NSP grantees. And the first one we have here is pretty straightforward. It's goals and performance milestones are not clearly defined. Spend a lot of time talking about making sure the agreements provide clear language. There were certain cases where some grantees were much more comfortable or had much more experience with a subrecipient relationship, and really just modified those types of agreements and used those as a basis for a developer agreement. And that may have, but that may also have not been specific enough to really get you where you want to be, to have those clear objectives, to have the clear deadlines with the developer. The other solution that's up here is ensure program manuals and procedures are in place. Of course, not everything is going to get into the agreement. That's really the goal, to make it as clear as possible, but there's a whole lot of process that goes on outside of the agreement And really, those program manuals and the procedures, as much as you can share with the developer, make sure the expectations are there. It's going to help to define the milestones. It's going to help to define what expectations there are as you run through the process with them. The next slide here, we're looking at a problem with a project not being on schedule. And a simple solution, increase resources devoted to oversight and inspection. Obviously, we talked about looking at the dashboard, looking at risk. You don't have staff necessarily that can be at all places at all times, or even to keep track down to a really granular level of each project going on, especially if you have a large program. So you want to look at those risks, and you want to adjust your resources and how you interact with the projects accordingly. One item I'd also recommend would be most places are doing construction inspections. There's a lot of information sharing. Typically, all the partners, the development team is at a progress meeting for construction. Talk to the architect, talk to the contractor, talk to the developer. It's a good way to, if you have the resources to do it, to have someone at a progress meeting or a job meeting to really get some firsthand experience, firsthand information. It may in some cases be a lot more robust than requiring a monthly report from the developer and using that to really look at what risks or what problems are coming up in your projects or with your developers. Second solution, maintain regular communication. And this is fairly obvious, but the development process is very much about managing relationships, managing the development team and the partners that you're working with. And Ben mentioned really what could be part of the solution if you can. If delays are caused by a grantee's internal process, and some of those processes can be adjusted fairly easily, something as simple as a draw request, making that more efficient, it may be a way to help a project get back on schedule. The third solution, evaluate incentives. We're going to talk about developer fees a little bit, but if your incentives are really moving out to other projects that the developer has going on, it's only natural that they're going to adjust and allocate their resources accordingly. So that's something you want to take a look at as far as a project getting behind. And finally, you want to reassess your schedules and enforce your agreements. There are certainly cases, and I think every construction manager out there understands that adjusting the schedule is just part of the job. There's no schedule that's perfect when it's set up front. So there may be legitimate problems or issues that come up, unforeseen items that come up that really do necessitate an adjustment of the schedule. Obviously, you want to make sure that you're not losing any of your key performance goals, both for your grant within your agreement, but adjusting the schedule may be part of the solution. And finally, enforce the agreements. Evaluate whether there are penalties associated with slow performance, decreasing funding. Ben talked about perhaps you reduce the workload or the scope of work for a developer, but really look at that agreement, look at what enforcement, what options are in place for you, and really adjust or use that as a tool to work a project back on schedule. Next problem up, developer not meeting performance goals, and really talking about unit goals here. So one of the solutions may be to look at the budgets and the actuals. Are the TDCs for your projects or the developer's projects 20% over budget, what was budgeted? And is there enough subsidy? Is there a way to look at subsidies both on the development side and then on the home buyer side if there are difficulties with sales to really help out in meeting performance goals, something that's at your disposal potentially? Maintain regular communication. This is something we mentioned with each of the problems. Stay in close contact and allocate resources based on an early warning system, based on your risk assessment of your partners. And again, the final solution, enforce your agreement. So take a look at your goals. If your budgets were not accurate, if it really is costing you a lot more money to do rehabs in your community, perhaps those goals weren't realistic, and it's something to take a look at. But also in the end, you want to make sure that you're you're enforcing and you're holding the developer to the performance goals that are in the agreement. Look at reduced funding, and then look at termination ultimately as the final tool available to you at your disposal. So developer fees, it's a means to incentivize good performance. The way the program is structured, this may be really the only incentive for the developer. This may be the only way of requiring the developer to return all the proceeds of the sale. The developer fee may be really the only incentive available to them. So a good thing to take a look at. Make sure that you're factoring in risk, and that's the developer's risk when you're setting your developer fees, and also looking at comparable profit in your area. And that's the key, because really we're looking at balancing incentive with undue enrichment. And as most grantees know, undue enrichment is something to watch out for. And the easiest way to prevent that is to look at what is comparable for a profit or for a fee in your community. Two other things just to take a look, or one other thing to take a look at is the aggregate of fees. The developer may also be including something like a construction management fee in their total development costs. You want to make sure you look at all the fees when you're really trying to compare that to what the market is bearing. This next slide is just a screenshot and image from the HUD policy alert for allocating development costs. This was updated recently. It was actually updated last month. And it's a nice comparison. The top portion is really a description and how administrative costs differ from the bottom section, which is overhead and profit, and really the developer's fee for developers. So it's a good resource that's available on the NSP Resource Exchange. That particular policy alert goes into allocating costs throughout the pre-development all the way through disposition. And we're sort of wrapping up here and just wanted to give out some other resources. There is a sample developer agreement on the NSP Resource Exchange in the toolkit, so if you're looking at ways to update, improve your current developer agreements, or looking to create new developer agreements, it's a great place to start to get a head start with those. Policy alert on allocation development costs. That was the previous slide was a portion of that policy alert. And then there's also a policy alert on developers, subrecipients, and contractors, which really gets into the roles of each of those types of entities within the program. And finally, there's a HUD webinar that will be coming up in November. We're at the last slide here, and it's really just additional resources and important links for the program. A lot of folks are probably familiar with these, but the resource library, all the policy alerts, FAQs, and the Ask a Question function is certainly something that gets a lot of use, and really to request technical assistance if you need help with these issues or anything else related to NSP.
Great, thank you, Matt and Ben and Mai. A lot of information there about the kinds of issues that come up with developers and some strategies for dealing with those. We'll be happy to take some questions now, just to refresh your memory about the kinds of things that were spoken about. Here was the agenda, and so you can ask questions in two ways. You can click your raise hand button if you have a phone icon next to your name in the participant list, and you can submit them in writing. And here's how you do both of those. And let's see, what do we have here from Kristen? And this would be something for David and John. Kristen says, please confirm that revenues received by developers are not considered program income, and that HUD has no intention to change this interpretation.
So Kristen, this is David. So I think one of the things that you have to understand, so that you see it's not just a policy position, is that the term developers is not explicitly stated in the regs, If you look at 570.202B1, you'll see a reference to private entities and individuals that carry out, that acquire property for the purpose of rehabilitation to assist households, low-income households. So what that means then is that we are looking at developers, right, which fit that definition, as beneficiaries, right? And when you provide assistance to a beneficiary, that assistance is not considered program income, right? However, if you as the grantee or subrecipient are to receive any funds, either, maybe you negotiate a split of revenues when property is sold or something like that, then any funds that you, the grantee or subrecipient, receive would be considered program income, but certainly not those funds that are being kept by the developer. Right. John, I don't know if you have anything else to add.
No, I think that's good. I mean, this is one of those cryptic kinds of secrets of CDBG regulations. Paul Webster's managed to create developers where you really can't see the word, as David said, and these folks referred to that at the beginning of this section, but it's not going away. It is. On the other hand, I mean, it doesn't mean the money's just gone, so you can just do anything you want with it. I mean, you have to be as responsible with the funds as you do with any other entity that you're dealing with. So it's just more complicated with developers. Thank you for that, Kristen. And this is a bit of a quiet crowd today, but here we go. We've got a question that came in from Tatiana. Tatiana, I'm going to unmute you. Hello? Can you hear me?
Yes, hello, how are you?
Good, thank you. Go ahead.
How about developers agreement? If the developer has a deal to purchase a piece of land, can NSP3 funds used to purchase that land? I understand that the answer is no, but I just wanted to confirm.
Well, so when are they purchasing the land? I mean, there's scenarios where the answer could be no, and there's scenarios where the answer could be yes. I mean, they could purchase the land if you have a development agreement that says you're going to go out and buy 6 houses, and you're going to redevelop them, and you're going to sell them for certain prices, and that's doable. So,
okay, now this one is basically vacant piece of land, okay? And the idea is for them to develop with other funds, other than NSP3 funds, the housing, rental housing on that piece of land. But basically NSP3 dollars will be used to acquire that piece of land by the developer.
Well, I mean, if you have all the agreements in place and you have done environmental reviews and everything else is taken care of the way that you have to take care of it prior to your committing to this developer, then I think you could make that work.
Yeah. Oftentimes when you give assistance to a developer, it's in the form of a loan. It's not a grant. It's kind of hard to justify. It's harder to justify giving the money to a developer. So I don't know, maybe that's what you're running into.
Yeah, well, I mean, maybe we need to talk about this a little bit more offline, but I mean, in principle, it's possible to do that. I mean, there's any number of, facts that could make it difficult for one reason or another that we can't get into here. But I think if you take a look at those development agreements that were linked on one of the last slides there, we have 2 developer agreements up on single-family homes, I believe. I mean, and it's not, there are sort of templates that
have applicability to multifamily as well. But the one that I think is useful is there's a kind of plain English version of a developer agreement for single-family homes, and there is a nice kind of guidebook that goes along with it that really explains what you're trying to get to with all these different requirements that you put into it. And so for people who haven't dealt with development agreements much in the past, I think that's a very good tool, because it's not just here's the language, but here's why it says what it says. But maybe you could send me an email or something, Tatiana, and tell me what's going on a little bit more, and we could sort out your particular situation. But I think it's potentially doable.
Okay, perfect. I really appreciate it. I always appreciate your help, so thank you. That'll be awesome. Okay?
Thank you, Tatiana. And let's go now to Kevin Meadows. Hi, Kevin. Hello, Kevin. Are you there? Perhaps you've muted yourself. No questions?
I just want to say good job and thanks for all the information today.
Okay, thank you. You're welcome. No questions, though, huh? It's all crystal clear. Very good.
I have something I could pass along, along these same lines. We've had number of people on the development team, the PA people, including Enterprise, talking about developer agreements, and one very experienced person was pointing out that there could be a lot of money at stake here, so you need a regulatory agreement that requires monitoring and enforcement, and it's harder to do if the grantee or another entity doesn't recapture all the net proceeds. So this is, sort of arguing to treat the revenues as something that you actually get back rather than that you allow the developer to keep. Now they could go back and reinvest it with the same developer, but you would maintain more control if you take the excess proceeds from a developer deal and sort of run them back through your organization. So that's one way to deal with it. But the reality is that particularly nonprofits or developers are struggling all the time, and of course for-profits are struggling all the time lately. And so there's always pressure to use those revenues for other purposes. So some organizations have established revolving loan funds that are well managed, accounted for, audited, and restricted in terms of how much operating funds, admin costs, and developer fees can be taken out of them, so that this isn't just a sort of cash cow for people. And you can't even count on auditors necessarily, because they won't necessarily know that there's a regulatory agreement controlling those profits or not. So this gets to control, I believe, that grantees should recapture the net proceeds and then regrant or relend them out to the same developers or other developers with tight performance and financial standards and controls. As an alternative, grantees should require that developers donate the net proceeds to an established loan fund or other public purpose entity that is able to exercise similar controls. So while the relationship with the grantee is relatively more open-ended than it is with a subrecipient, your responsibilities aren't any lower. And so the trick is, how do you take a developer situation, which can bring you more flexibility and faster programming and so forth, but then reduce the downside risks of having that money go too far into other purposes. And so I think what we're hearing today is that you need these kind of controls, but I think this additional level of concern is, well, there still can be revenues, and because we can't perfectly predict what those revenues would be, as great as our spreadsheets are, therefore, we need to have some sort of an agreement that incorporates more, brings more control back to you as the grantee over the subsequent use of those funds. And it doesn't mean you have to tighten it up, and it doesn't mean you always have to have them come back, but you have to make sure they're doing the right kind of things, and that they're not just paying for salaries or whatever. And that's hard to do.
There was a slide that Maya and Ben were discussing, this one, and they mentioned their Building Sustainable Organizations paper that they had done, and I'm going to put in the chat box a link to that Building Sustainable Organizations report, in case you're interested in that. And
I'd like to object to that comment. And if people think that's the NSP program with all the baggage on top, I'd take that personally.
I'm not sure that was the intent. While we're waiting for other questions, let me remind you that this event is being recorded, and the archive will be posted on the Resource Exchange website, and that usually happens rather quickly. It'll include the recording along with the PDF version of the slides that you've seen today. And once it's prepared, there will also be a written transcript posted there. And still a number of NSP webinars on the schedule coming up, starting on the 20th, so that's next week, and on into December with these 5. John, I'm shocked by the quiet nature of today's crowd. It is a big crowd. There's a lot of you out there.
They're all anonymous. They don't want to ask us. I see all these people that are just signed in as number 27. That's a good sign. Okay, so you can send in questions anonymously too. We know you have them. So it's okay to be. It's okay to have a lot of questions about this, and I think it's okay to ask them. If you're nervous about it, that's understandable. But this is probably the hardest thing in NSP and the hardest thing in CDBG if anybody's using developers in CDBG. And it's harder than home because you don't have the same sort of requirements and structure about subsidy layering and how to do it all. But I would put it to you that this is actually a blessing because it means you get to write your own sort of rules as long as you're meeting the requirements of the program. There's more than one way to meet it, and every developer has something that appeals to them more than another thing in terms of benefits or outcomes or compensation or whatever. So when you get these rigid one-size-fits-all approaches, it's frustrating. If you don't have something that fits into that. So I don't think we're trying to scare you away from developer deals. I think they are preferable in a lot of ways. There is more flexibility. They don't have to use procurement for their contractors. So if they have a general contractor and a stable of subs that they're always working with, they can use those people. They have to show you that their costs are reasonable, but they don't have to have a sealed bid process that runs 90 to 120 days and slows down your production. So on that level, they're better. I think they can work more flexibly than a subrecipient frequently can. There's good things about developers, and I think that in order to take advantage of their capacity to do more potentially faster, you just have to be understanding about the need to balance that off with appropriate controls. But I don't think more controls is necessarily more appropriate. I think the right controls are appropriate. So I think this has been a good slideshow, I think, of kind of focusing on what are the real issues here. And if you can resolve those, the rest kind of takes care of itself. So, but it's scary because you never really know what they're thinking. You don't really know what their cost structure is a lot of times. Or, there's things you will never find out. So if you are the kind of person that has to have 110% of the facts nailed down first, you should work with subrecipients. You will not be happy working with developers. But if you can work with a little more flexibility, and if you have some developers that you trust, which I think is important, then I think you can do better things with them.
Good advice there. When it is time to leave, you will be taken to a survey form automatically, and we hope that you'll take a moment to answer the questions on that form, give us some feedback, let us know what worked in this webinar for you, what maybe you'd like to see happen differently next time, and topics you'd be interested in. Well, thank you in advance for doing that. And now we've got a couple more questions. Let's go. Lisa's question is, what does a grantee do if they have not properly prepared the documents to control the developers?
Some of our friends from Enterprise want to take a shot at that?
Yeah, this is Matt. I'll sort of start out. I think we've come across this in a number of situations, and for the most part, it's been an exercise of coming back and really working with the developer to adjust agreements. I think it's possible to continue with the arrangement, but if there are issues and the documents aren't there, you're really taking a risk. If you don't feel comfortable with the documents and you run into trouble, there's nothing to fall back on. So I think in our experience, we've been able to revise agreements, amend agreements, and really update. Of course, you need to work with your developers on that.
Yeah, but I agree. I think that it's, in 95% of the cases, they're not going to be really opposed to what you're asking for because they're at risk to some extent too. They don't want to be looking like they are retaining more income than they're supposed to. So it's in their interest to work these things out with you. And I've seen any number of cases where that's happened. If you are having trouble renegotiating an agreement or working something out, you should talk to your field office, maybe get some technical assistance. If you don't have a TA person that's working with you already, you request one. It may not be that difficult, but you do have to do it. And I think that ultimately, I think what people are afraid of is having to repay funds with local resources, which are non-existent these days. So we understand that that's not a great choice for you. But we have other ways of resolving problems, and if you can show us that you've made efforts to resolve a problem, once you realized you had it, and have kind of reversed some of the problems that you had, or taken out some of the language, or put back in some language, or whatever it is to your agreement that you wish you had the first time around, that goes a long way to allowing us to say, well, it was a capacity issue, and we're not going to come in with the worst possible sanctions. If 12 out of 12 of your deals have gone bad and you haven't done anything about it, that's a different story. But so I think in all these things, your best efforts are your best defense against sort of more scary sanctions.
Carol asks, how does HUD recommend progress payments for developer fees?
Well, I think this show here, the slideshow here made a pretty good point about different ways of making progress payments. I mean, that's something that you can negotiate with the developer too, in terms of what is what are the milestones that you want to get to. There's some fairly standard kind of milestones in construction, framing or plumbing, painting, different levels of completion. But you can modify those. If you just go with a straight percentage, it's kind of hard to tell if something's 20% done instead of 19% done. I think you want to try to peg it to some visible physical progress, but maybe Matt or I could expand on that a little.
Yeah, I'll take a crack at it. I think mostly, in most cases, folks work off of a monthly payment schedule. So you're really going out, whether you have an architect or whoever is in charge of really inspecting for the progress payment, going out on a monthly basis, verifying the work's complete. Obviously, you're going to verify that the program requirements are in compliance and the documentation's in place, but I think typically it's done on a monthly schedule. I have seen a few grantees do things on a percentage basis, but as Don said, it's, I think, a little bit easier to peg the payment to something you can really go out and verify rather than an arbitrary percentage. Maya, I don't know if you have anything to add there. Or Ben.
You did a great job.
Well, let's move on to Mario's question. Bit of a scenario here. He says, we're working with a developer. I need to discuss an issue regarding the second loan, soft second requirements. And he's wondering who he can call for that information. And some more project information was it was a foreclosed rental multifamily project. The NSP funds were used to purchase the building from the bank. Is that enough information? There we go. There's more. Debt coverage ratio is below 1.2. Can the second loan be forgivable with zero interest, but the developer is required to pay the funds back in 20 years?
You guys want to go first? The answer is yes. Now you can tell them how. Well, I think the nice thing about developers in developer agreements is there's a lot of flexibility in how you do it. So, I mean, particularly if it's a nonprofit, it's not unusual to see these kind of loans function as debt on a monthly basis, and therefore, keep sort of challenging your cash flow or whatever. But I mean, this is where underwriting comes in, and that's a whole program in and of itself. And if you haven't taken one of the NDC underwriting courses, you really need to get yourself to one. We're going to have another set coming up. But what your underwriting should tell you is, well, what can I expect to generate in terms of revenues, and sort of what are my expenses, and then where's that going to leave me to pay various sorts of debt on this thing. And the nice thing about NSP, and it's true of CVG as well, is that you can structure it as pretty much any way you need to structure it to make the deal work. Well, that's what I would say, just in terms of advice, is that you don't want to just leave it in there and the heck with it. I think you want to put it in there in a way that incentivizes them to maximize that resource and not to sort of just take advantage of it and kind of squander it.
Yeah, and I would only add that you're probably going to have a methodology with your underwriting to look at, really, as John said, what the project needs, what the gaps will be, or the ability to repay over time. And having that methodology, I think goes a long way to just showing the due diligence and the underwriting and the review that was done up front.
Now, Paul Lester has all along recommended lending funds instead of just granting them to developers. So, at a minimum, if you can make it work this way, that gives you the assurance that you are not giving the money away, and that at least there is some prospect of repayment, and that there is relatively little ability to sort of misuse those funds. But they could still, it's pretty easy to manipulate the sort of the the accounting on real estate projects in a number of different ways, and not even, sort of from evil intentions, but, there's different ways you can set things up so that it looks like you don't have any more money left. But having your deal structured as a loan is just inherently less risky for you because it gets you halfway towards the argument that people are not unduly enriching themselves. It doesn't get you all the way there because they can still try to make sure there's no money left by the end of the period. But it's a better way to do it.
Let's go to Pete Thornburg. Hi, Pete. Looks like you've got a couple of questions. Hello, Pete. Pete, are you there? Not working out. So let's try his, just reading them off. So Pete asks, question 1, can a developer prepay operating reserves for a scattered site single-family lease purchase tax credit project partially funded with NSP2? And that was money using the 25% set-aside. The operating reserves are not a condition of funding, and the developer cannot begin building until 2012.
Well, that's a policy thing that we've been wrestling with for a while. We are trying to issue policy that allows the establishment of operating reserves. Currently, they are not allowed. And so, apparently, I just found out in trying to move this again that I think it's some sort of waiver. I think it's something that we can do in-house here, but it takes a little extra time. So, this was sort of bound up with the public housing authorities as developers issue, and we've decided to split it off. You can use cash flow for both replacement and operating reserves, but currently you can only establish operating reserves if a third-party lender requires it. Now, in your case, that may be the situations, because it sounds like you've only got partial funding through NSP. We've seen a lot of lenders asking for that. We've even seen some kind of twists on this in terms of having some reserves or deposits up front for certain activities. But as far as operating reserves, which are basically an insurance policy that your cash flow won't go negative if your occupancy goes way down or your expenses go way up. For some reason that I don't understand, that has not been eligible in CDBG. We're trying to make it eligible for NSP. It's not done yet, and it's probably going to take another couple months. So if your lender is requiring it, you can do it. If not, it'll take a little while longer. Sorry.
And his second question is about the same developer, and the question above. Can that same developer invoice for all or part of the development?
I think that's a bad idea, unless they split it with me. But, I mean, you really want these developers to have an incentive to finish the project properly, on budget, and on schedule. And if they have already pocketed their fee, a lot of that incentive goes away. So, nonprofit developers often defer their fee and contribute that as a form of equity in tax credit deals. But I just think from a sort of human motivation standpoint, it's bad. It's a bad idea.
Yeah, and I think most grantees have either are waiting to the end of the project, and the end meaning the sale of the home, or are doing a percentage, perhaps at the completion of construction. But obviously, the home needs to sell for it to become an NSP unit, for the household there to be eligible, and so forth.
Thanks for those questions, Pete. picked up a little bit there. Bit of a flurry of questions, but slowed down again. So I guess this might be a good time to say thank you to the panelists who were here and helping us through this issues with developers. Ben Nichols, Mai Trin, and Matthew Doe, all from Enterprise, and of course John Laswick and David Noguera, with their insights from within HUD and the NSP program. Thanks to all of you, and let's see, yep, it looks like that's it. So we look forward to seeing you all soon in another HUD NSP webinar, and the next one is October 20th. Take care, everyone.
Thanks, everybody.